So usually when we talk about getting a medical diagnosis, right, there's this comforting expectation of just absolute precision.
Right, yeah. Like you break your arm, they take an X-ray, and there's the jagged line.
Exactly. The doctor just points to the film and says, well, there's your problem.
Yeah.
But when you step into the world of investing, and specifically when you're trying to diagnose the financial health of a hyper-growth tech company, that X-ray machine gets, I mean, incredibly murky.
Oh, completely. The imaging is terrible.
It really is. And we are looking at a pretty massive shadow on the financial X-ray of an AI cloud provider today. Because on paper, it looks like a fatal margin collapse.
Dropping all the way to 1%, right?
Yeah, 1%, which looks like the business is dying. But it might actually be, the growing pains of a massive new muscle being built.
And diagnosing whether that shadow is a structural disease or just a symptom of hyperscaling is arguably the hardest puzzle in modern finance. I mean, if you get it wrong, you either buy into a massive value trap or you miss out on a generational wealth compounder.
Which is the exact puzzle you and I are solving today.
Oh.
So welcome everyone to today's deep dive. We are stepping into the shoes of a public market investor, but we're playing a very specific game today.
A very specific game.
Right. We are not looking for a stock to flip next quarter. We are hunting for a business with the fundamental strength to buy and hold forever. Perpetual ownership.
The Holy Grail.
The Holy Grail. And our subject is CoreWeave, which is a company dominating the AI infrastructure space. But before we get blinded by the staggering scale they are operating at.
Because the scale is crazy.
It is. I mean, hitting $5 billion in run rate revenue faster than any cloud provider in history. But before we get into that, we have to establish the rules of engagement for this deep dive.
Yeah, and the most important rule here, the one we have to stick to, is that we are completely ignoring the stock price.
Completely.
The current valuation, the market sentiment, the daily trading volume, none of that matters for this analysis.
None of it. We are building a long investment thesis based strictly on the mechanics of the business itself. And we've got 4 foundational pillars to evaluate.
Okay, let's lay them out.
First, the durability of the secular tailwinds. Basically, is the wind actually at their back for a decade? Second, the strength of their competitive moat.
Right.
Third, the intellectual honesty of their unit economics, which, by the way, is where we will dissect that terrifying margin collapse.
That's going to be a fun one.
Oh, yeah. And fourth, the quality and alignment of your management team.
I like this approach because by stripping away the noise of the stock ticker, we are forced to focus purely on business quality. The ultimate question is, can this entity generate returns above its cost of capital sustainably over a 5 to 10-year horizon?
Exactly. So let's start with that first pillar, the secular tailwind. Because if the demand isn't structural and durable, I mean, the rest of the business model is kind of irrelevant.
Yeah, it doesn't matter how good your moat is if the river dries up.
Exactly. Now, the prevailing narrative over the last few years was all about training foundation models.
Right.
The massive hyperscalers and elite AI labs buying tens of thousands of GPUs just to teach AI how to form a coherent sentence.
Yeah, and that was the initial surge. And honestly, it's what originally put CoreWeave on the map. But the fear hovering over the market was always this, what they call the college graduation problem.
The college graduation problem.
Yeah, so think about it like this. You send an AI model to an incredibly expensive compute university to get trained, but you only train it once.
Right.
So the bear case was that once these massive foundation models finished their initial training runs, well, the demand for compute would just fall off a cliff.
Oh, I see. Because they graduated, they don't need the university anymore.
Exactly.
But looking at the source material we have, the exact opposite is happening. The demand isn't falling off a cliff at all. It's actually compounding. Because we are seeing the industry aggressively shift toward inference workloads.
Right, and inference is the actual application of the model. It's the AI graduate entering the workforce and actually doing a job.
Like answering a prompt.
Yeah, every time you ask a chatbot a question or generate an image or, ask an AI to summarize a legal document, that requires inference compute. But it goes so much deeper than simple prompts now. We're really entering the era of agentic AI.
Okay, let's trace that out for the listener because agentic AI completely changes the math on compute intensity.
It really does. It's a whole different ballgame.
Right, because if I ask a standard AI to write an email, it generates the text once. That is one inference request. But if I deploy an autonomous AI agent and I tell it to research 5 competitors, draft a market analysis, cross-reference it with our internal sales data, and format it into a presentation.
Yeah, that agent is going to spin up dozens, maybe hundreds of parallel inference requests.
Exactly. It's talking to other models, querying databases, running iterative loops entirely in the background.
And so the compute required for a single agentic task is just orders of magnitude higher than a simple chat prompt. And the crazy thing is, this isn't theoretical future casting anymore.
No, it's happening now.
Broad enterprise production is finally coming online. You've got companies like Cognition, Cursor, Mercado Libre, Midjourney, Runway. They're aggressively deploying these complex AI workflows into their daily operations.
So the compute intensity is astronomical and it's continuous.
Yes.
And we can actually put some staggering numbers to that scale based on the market markers in our sources. Because we're looking at Microsoft signing a $250 billion contract with OpenAI.
Wow.
Yeah. Oracle signing a $300 billion contract.
Yeah.
I mean, these are not speculative investments. These are massive, multi-decade capital commitments from the largest tech companies on Earth.
And for CoreWeave specifically, this shift has translated into a revenue backlog that almost defies logic. I mean, let's look at the trajectory here.
Let's do it.
At the start of 2025, CoreWeave had a $15 billion revenue backlog, which is huge.
Already massive.
But then, by the end of 2025, that expanded to $66.8 billion.
That's insane.
And it gets crazier. By Q1 of 2026, their backlog hit nearly $100 billion. Specifically, $99.4 billion in contracted future revenue.
$100 billion in future backlog for a company that just went public.
Right.
I mean, you hear people default to the old cliche, right? CoreWeave is selling picks and shovels during the AI gold rush.
Right. Everyone loves that phrase.
I really dislike that analogy here, though.
Why is that?
Because a shovel is a one-time transaction. You sell the shovel, the miner digs a hole, the transaction is completely over. What CoreWeave is building operates on a totally different mechanical level.
Okay, what's a better analogy then?
It's more like building the actual physical power grid for a new industrial revolution.
Oh, I like that.
Right. If you're building an automated factory, you don't buy the power grid. You subscribe to it. You draw electricity from it continuously, forever. And as your factory expands, you just draw more.
That framing completely alters how we view the durability of the demand. And actually, Michael Intrater, CoreWeave's CEO, he made a really critical observation on their Q1 2026 earnings call.
What did he say?
He noted that the primary constraint in the AI industry is no longer whether enterprises or AI labs want to deploy capital. Like, the desire is insatiable and the funding is secured.
Right, the money is there.
The single biggest bottleneck in the global AI supply chain right now is how quickly, reliable, high-performance compute capacity can actually be delivered and plugged in.
So the demand profile isn't a temporary spike. It's not a bubble. It's a structural plateau.
Yes.
The entire global economy is trying to digitize and automate simultaneously, and they are literally all bottlenecked at the door of physical infrastructure.
And the workloads are only getting heavier. Management described running Grace Blackwell systems at scale on CoreWeave Cloud as literally revolutionary for their clients.
Right.
It's not just the elite hyperscalers anymore, right? AI-native startups, traditional Fortune 500 enterprises, sovereign entities, they're all fighting for the exact same scarce capacity.
Okay, so we can confidently validate the first pillar. The secular tailwind is a generational infrastructure expansion. The demand is practically infinite.
Agreed.
But that immediately raises a massive red flag for any investor looking for a perpetual hold.
Oh, what's the red flag?
If the demand is so obvious and the capital is so incredibly abundant, why can't a well-funded competitor, say a sovereign wealth fund or a massive legacy cloud provider, just buy 100,000 NVIDIA GPUs, rack them up in a warehouse somewhere, and steal CoreWeave's customers? Which brings us perfectly to evaluating the competitive moat.
Yeah, and this is where the market suffers from a massive illusion of commoditization. There is this really pervasive assumption that a chip is a chip.
Right.
People assume an NVIDIA H100 GPU sitting in some legacy cloud data center delivers the exact same performance as an H100 sitting in a CoreWeave data center.
It's what I call the gasoline fallacy.
The gasoline fallacy.
Yeah, we assume that a gallon of premium gas at Shell is identical to a gallon at Exxon, so we just shop on price and location.
Right. But in the realm of high-performance AI compute, that assumption breaks down completely. As management explicitly stated on their MS conference call, infrastructure is not fungible.
It's not fungible. Okay.
The silicon itself might be identical when it leaves the NVIDIA factory, sure, but the output, the actual performance the client experiences is wildly different based on the architecture wrapping around that silicon.
Okay, let's dive into the engineering of why that is. Because why does the surrounding architecture matter so much for an AI workload compared to, say, just hosting a standard website?
Well, when you're hosting a website, the servers act mostly independently.
Right.
One server handles my request to load the homepage, another server handles your request.
Simple enough.
But when you are training a frontier AI model or running complex agentic inference, you aren't using a single GPU. You are distributing a single, massive mathematical problem across a cluster of tens of thousands of GPUs working in parallel.
So they have to act like a single synchronized brain.
Exactly. And for them to act like a single brain, they have to communicate with each other constantly. They're sharing intermediate calculations back and forth millions of times a second.
Okay.
If there is even a microsecond of latency, like a tiny delay in how fast data moves between server A in rack 1 and server B in rack 50, the entire training run stalls.
Just from a microsecond delay.
Yes. The GPUs literally sit idle, waiting for data to arrive. And when an AI lab is paying millions of dollars a day for compute, idle GPU time is catastrophic.
So the moat isn't owning the chips. The moat is building the nervous system that connects the chips.
Precisely. Let's look at the specific technology stack CoreWeave has built to solve this. Because they aren't just racking hardware, they have engineered a purpose-built software and networking layer from the ground up.
What does that stack look like?
Well, they have CoreWeave Mission Control, which handles security, deep observability, and the lifecycle management of the entire fleet. And then they built the CoreWeave Kubernetes Service, or CKS.
Let's pause on Kubernetes for the listener, because that's a pretty dense term.
It is.
At its core, Kubernetes is an orchestration system. Like if you have 10,000 containers of software running across a massive cluster, Kubernetes is essentially the traffic cop deciding which server does what work.
Right.
But standard Kubernetes wasn't designed for the sheer velocity and weight of AI workloads.
Which is exactly why CoreWeave built an AI-native orchestration layer. But, the software is only half the nervous system. The physical networking backbone is just as critical.
Right, the actual cables and switches.
Exactly. They utilize state-of-the-art networking technology, including NVIDIA Quantum X800, which enables 800 gigabits per second of connectivity.
800 gigabits.
Yeah. And they engineer ultra-low latency interconnects between the server racks. They're literally designing the physical layout of the data center to minimize the microscopic distance data has to travel over fiber optic cables.
Wow, so it's extreme optimization. And it extends beyond just the processing power, right? Because our sources also highlight the explosive growth of their AI object storage product.
Yes, that's a big piece of the puzzle.
Let's unpack the mechanics of that. Why is specialized storage a moat? I mean, storage is storage, right?
Not for AI. Because AI models ingest petabytes of unstructured data. We're talking images, video, raw text.
Okay.
Traditional cloud storage systems are often built for block storage, which is great for standard databases, but it's terrible for feeding an endless fire hose of unstructured data into a massive GPU cluster.
Oh, so it creates another bottleneck.
Exactly. So CoreWeave built a storage service that combines exascale, AI-optimized object and file storage with GPU local caching.
Meaning the data is stored physically closer to the GPU that needs to process it.
Exactly, eliminating another latency bottleneck.
And the market adoption of this specific product is just incredible. They eclipsed $100 million in annual recurring revenue for their storage platform in Q3 of 2025 alone.
Yeah, $100 million in ARR just for storage.
Customers are committing to multi-year contracts just to house their petabytes of core training data on CoreWeave's architecture.
And housing that data ties directly into what I think is their most aggressive distribution advantage.
Oh, the zero egress migration program.
Yes. This completely weaponizes the standard business model of the legacy cloud providers.
It really does. To understand why it's a weapon, we have to understand the artificial moat the legacy clouds built over the last decade.
Right, the digital roach motels.
Exactly. They operate like digital roach motels. They make it incredibly cheap, sometimes even free, to upload your data onto their servers.
Yeah.
But the moment you want to move that data, whether to a competitor or back to an on-premise server, they hit you with massive egress fees.
They charge you by the gigabyte just to retrieve your own property.
It's crazy. It's a punitive friction designed entirely to hold your data hostage. It ruins the unit economics of switching providers, even if a competitor has better or cheaper compute.
And CoreWeave assessed that landscape and introduced zero egress migration. They basically eliminate or drastically reduce the fees to move data across their backbone.
It's a remarkably confident bet. I mean, think about a theme park that decides to tear out all the exit turnstiles.
I love that.
Right. The legacy tech playbook is all about lock-in, making it too painful to leave. By dropping egress fees, CoreWeave completely removes the friction for customers to arrive. They are betting 100% on the quality of the rides, the sheer performance of their low-latency architecture to keep the customer inside the park.
That takes extreme operational conviction. But there is a final layer to this competitive moat that is entirely physical, and in many ways, it's the hardest thing to replicate.
The global electrical grid.
The global electrical grid, the ultimate bottleneck.
Yeah.
Running tens of thousands of H100 or Blackwell GPUs requires an immense continuous flow of power. By Q1 of 2026, CoreWeave had secured over 3.5 gigawatts of contracted power.
3.5 gigawatts.
And in that single quarter alone, they added 400 megawatts of contracted power, with the vast majority expected to be online by the end of 2027.
We really need to give that number some context because 3.5 gigawatts is kind of an abstraction to most people.
It's hard to visualize.
A standard large data center from 10 years ago might draw 20 or 30 megawatts. 3.5 gigawatts is the energy footprint of a medium-sized American city.
Wow!
And securing that power isn't just about paying a utility bill. The global power grid is severely constrained, not just in generation capacity, but in actual transmission.
Right, moving the power to where it needs to be.
You cannot simply build a warehouse, buy some GPUs, and ask the local utility to run a 100-megawatt line to your building. Upgrading a local substation or laying high-voltage transmission lines can take 3 to 5 years of regulatory approvals, environmental studies, and physical construction.
So CoreWeave's aggressive early land grab for power capacity forms this massive physical barrier to entry.
Yeah.
I mean, a competitor could raise $20 billion in venture capital tomorrow to buy chips, but if they can't secure the electrical interconnection agreements, those checks are literally just expensive paperweights.
Exactly. And CoreWeave actively partners with local leaders, regulators, utilities early in the planning process to integrate their infrastructure responsibly. So this deeply embedded power portfolio is an asset that simply cannot be spun up overnight, regardless of a competitor's funding.
Okay, so summarizing the moat for our perpetual hold thesis.
Let's recap.
We have an orchestration software layer that extracts maximum performance from the silicon. We have a zero egress distribution strategy that breaks the legacy cloud's artificial lock-in. And we have a 3.5 gigawatt physical power portfolio that acts as an insurmountable geographic and regulatory barrier to new entrants.
The competitive moat is definitively robust.
It is. But building a carrier-grade network backbone and securing 3.5 gigawatts of power facilities requires a terrifying amount of upfront capital.
Terrifying is the right word.
How a company funds its infrastructure build-out is often the deciding factor in whether it actually survives to see its moat mature. So we need to evaluate their financial engine.
And this is where the story usually goes completely sideways for a hyper-growth tech company.
Usually, yeah.
The traditional Silicon Valley playbook is incredibly destructive to long-term shareholders. A company grows fast, burns through its cash reserves, and then goes back to the public markets to issue secondary stock offerings.
Right.
They dilute the existing shareholders to oblivion every time they need to buy a new server rack. Or they take on massive corporate debt with floating interest rates that just crush their cash flow during a downturn.
But CoreWeave has engineered a completely different capital structure. In their annual report, they describe it as creating a new asset class.
A new asset class.
Yeah. It is a structural innovation that completely insulates them from the venture capital cycle. And to understand it, it requires a deep dive into the mechanics of their customer contracts.
Okay, how exactly are they paying for tens of billions of dollars in infrastructure without destroying the equity value of the company?
Well, they tie their capital deployment directly, legally, and mathematically to long-term contracted demand. In 2025, 98% of CoreWeave's revenue came from long-term committed customer contracts.
98%.
Yes. The weighted average length of these contracts was extended from 4 years to 5 years, and critically, a massive portion of this backlog, north of 60%, according to the UBS call, is with investment-grade customers.
Okay, let's break down the mechanics of a take-or-pay contract for the listener, because this is vital.
Okay.
An investment-grade customer, say a massive Fortune 50 software company, comes to CoreWeave and says, we need a massive GPU cluster for the next 5 years. They sign a binding legal agreement to pay a set amount every single month, regardless of whether they utilize 100% of the compute or 10% of the compute.
So the revenue is mathematically guaranteed.
Exactly.
CoreWeave isn't building spec data centers and just hoping customers show up. The customers are fully locked in before the concrete for the server room is even poured.
It operates entirely differently from a software company.
Right.
It actually operates exactly like a commercial real estate developer building a skyscraper.
Oh, that's interesting. Walk me through that.
Okay, if a developer wants to build a billion-dollar office tower, they don't use their own cash, and they don't sell pieces of their development company to raise funds.
Right.
They go find an anchor tenant, like a massive global bank, to sign an ironclad 10-year lease for half the building. The developer then takes that signed lease to the financial markets, and the banks finance the construction of the building based strictly on the guaranteed future cash flows from that specific anchor tenant.
Wow. The analogy holds perfectly. CoreWeave uses these investment-grade take-or-pay contracts to secure asset-backed, self-amortizing debt.
Asset-backed debt.
Yeah. The debt isn't tied to the speculative future valuation of CoreWeave's corporate entity. It is tied directly to the guaranteed cash flows of the specific AI clusters being built.
And the scale at which they are executing this financial engineering is just staggering. Between 2024 and early 2026, they secured over $25 billion in debt and equity capital. In early 2026 alone, they closed an $8.5 billion delayed draw term loan 4.0 facility.
We really should unpack what a delayed draw term loan actually means because it highlights the sheer efficiency of their capital allocation.
Please do.
Okay, if a company takes a standard $8 billion loan, the money drops into their bank account on day one, and they immediately start paying interest on the entire $8 billion, even if it takes them 2 full years to actually spend the money on building the data centers.
Which creates a massive negative drag on cash flow. You are essentially paying interest on dead money just sitting in a checking account.
Exactly. A delayed draw term loan solves this entirely. CoreWeave secures the commitment for the $8.5 billion from the lenders, but they only draw down the cash in tranches.
Like pieces of it.
Right. Say $500 million at a time, exactly when they need to pay NVIDIA for the GPUs or pay the construction firm for the facility build-out. They only pay interest on the capital they have actively deployed. It maximizes capital efficiency and minimizes interest drag during the construction phase.
That is brilliant. And as they have proven their ability to execute this exact model, the financial markets are rewarding them with incredibly cheap capital. I mean, in 2025, they secured $18 billion while actively reducing their weighted average cost of debt by more than 300 basis points.
Which is massive. A 300 basis point reduction is a 3% absolute drop in the interest rate they're paying.
Right.
On an $18 billion debt load, that is not a rounding error. That translates to roughly $700 million in annualized cash savings based on their year-end debt balance.
$700 million.
That is pure equity value creation driven entirely by financial credibility.
So let's look at the structure of that debt, too, because CFO Nitin Agrawal explained that this debt is self-deleveraging. What are the actual mechanics of that?
It means the principal and interest payments on the debt are perfectly matched to the cash flows coming in from the customer contracts.
Okay.
As the customer pays their monthly invoice for the AI compute, a portion of that cash automatically flows to the lenders to pay down the debt on that specific cluster, while the remainder flows back to CoreWeave as free cash flow.
So it pays for itself.
Exactly.
Yeah.
Because of this self-amortizing structure, CoreWeave essentially has no major corporate debt maturities looming over their head until 2029.
It's just a masterclass in risk mitigation. They are aggressively scaling physical infrastructure without putting the parent company at risk of a liquidity crisis.
Yes.
But, a great management team doesn't just raise cheap debt, they deploy it intelligently for inorganic growth as well. So let's examine their M&A strategy, specifically the massive Core Scientific acquisition they executed in Q2 of 2025.
Assessing M&A execution is vital for a perpetual hold thesis because bad acquisitions destroy more shareholder wealth than almost anything else.
Oh, absolutely. Egos get involved and
Okay.
billions are lost.
Right. But the Core Scientific deal is fascinating because it wasn't just a blind grab for capacity. It was a calculated exercise in vertical integration.
Just for some context for the listener, Core Scientific was a major player in the data center hosting and crypto mining space. They owned massive physical facilities with heavy power infrastructure, and CoreWeave was actually a major tenant of theirs. So why buy the company outright?
Think about the unit economics. Every time CoreWeave deployed a new GPU cluster in a Core Scientific facility, they were paying rent.
Makes sense.
They were paying for power, cooling, and facility management, and Core Scientific was baking a profit margin into all of those services. By acquiring Core Scientific, CoreWeave essentially bought their own landlord.
And what happens mechanically when you buy your landlord?
You immediately eliminate the rent expense. The financial impact was profound. By vertically integrating this infrastructure supply chain, CoreWeave wiped out over $10 billion in future lease liability overhead from their balance sheet.
$10 billion in future obligations instantly eliminated just by absorbing the asset.
Furthermore, management anticipates that this integration will generate $500 million in fully ramped annual run rate cost savings by the end of 2027.
Wow.
They stripped out the duplicated corporate overhead, streamlined the facility management, and internalized the profit margins they were previously paying to a third party. It structurally enhances their long-term operating margin profile.
Plus, the deal structure was engineered to be leverage neutral to CoreWeave, meaning it didn't disrupt their broader debt strategy or balloon their corporate risk profile.
Right.
And they acquired a portfolio of legacy crypto mining assets in the process, which is interesting.
Very. It provides them with massive medium-term optionality. If the AI demand stays red hot, they can rip out the crypto miners and retrofit the power infrastructure for highly lucrative AI GPU clusters.
And if they don't want to do that?
If they need to raise cash, they can simply divest the crypto operations entirely. It's an incredibly asymmetric bet.
Okay, so evaluating the financial engine, the evidence is compelling. They pioneered an asset-backed debt model that continuously lowers their cost of capital, completely insulating equity holders from dilution. And they demonstrated the ability to execute highly complex, value-creating M&A that drives massive structural cost savings.
Yeah, they hit it out of the park.
Okay, if we stop the analysis right here, the picture we are painting is an absolute juggernaut.
Unstoppable.
A compounding secular tailwind, a multi-layered technological and physical moat, and a capital allocation strategy that literally prints money while mitigating downside risk. It sounds like a screaming buy.
Whoa.
But this is the deep dive.
Right.
We are committed to absolute intellectual honesty, and there's a glaring, terrifying reality on their Q1 2026 income statement that we must confront.
The margin collapse.
Yes, the margin collapse. Let's look at the raw numbers here. In Q1 of 2026, CoreWeave's top-line revenue was an incredible $2.1 billion. That is up 112% year over year. True hypergrowth. But their adjusted operating income, which is the actual profit generated from running the business, was only $21 million.
Which leaves them with an adjusted operating margin of just 1%.
1%. To put that in perspective, in Q2 of the previous year, their adjusted operating margin was a very healthy 16%.
And the bottom line looks even worse. Their adjusted net loss for Q1 2026 was $589 million. That is a negative 28% net margin.
Now, applying our perpetual ownership framework, if a company's core unit economics are deteriorating this rapidly, the investment thesis is dead on arrival. I mean, you cannot make up a negative 28% margin on volume.
No, you definitely can't. And this brings us to the most critical diagnostic question of our entire evaluation.
Which is
this margin collapse evidence of a fundamentally flawed, unprofitable business model? Or is there a mechanical, accounting-based explanation driven by the sheer velocity of their infrastructure deployment?
right. Because if they are discounting their compute, essentially selling $1 for 90 cents just to artificially pump up top-line revenue growth, we walk away right now.
Exactly. To find the truth, we have to look past the top-line numbers and rigorously dissect GAAP accounting rules. The key to this mystery lies in the timing mismatch between cash flows, capital expenditures, and revenue recognition.
Okay, let's trace the life cycle of a single CoreWeave customer contract from day zero. Let's map it out.
Okay, let's do it.
Day zero. A major AI lab signs a 5-year take-or-pay contract for a new GPU cluster and wires an initial prepayment. The revenue is secured. What happens next, mechanically?
CoreWeave cannot just flip a software switch to turn on the cluster. They have to physically build it. This triggers an approximate 3-month installation and deployment phase.
3 months.
Yes. And during these 90 days, CoreWeave incurs massive financial outflows. They are deploying hundreds of millions of dollars to purchase the NVIDIA GPUs, the Quantum X800 networking switches, the cooling systems. They are paying specialized labor to rack and cable the servers.
So they're bleeding cash. But how does that hit the income statement?
Yeah.
Because buying equipment is a capital expenditure, so it goes on the balance sheet, right?
It goes on the balance sheet, yes. But under GAAP accounting, the moment that equipment begins deployment, CoreWeave starts taking heavy depreciation and amortization charges against it. Furthermore, They are immediately incurring the facility costs, the rent, the basic power requirements just to test the systems. All of these massive expenses are hitting the operating income line before the system is fully handed over to the customer.
So for 3 whole months, the income statement absorbs all the pain of building the cluster with no revenue to offset it.
Exactly. Then, around month 3, the deployment is complete, the AI cloud goes live, and the customer begins running their workloads. Now the revenue starts flowing.
Nice.
But here is the critical accounting catch. Under GAAP rules, CoreWeave cannot recognize the total value of that massive multi-million-dollar contract all at once. They must recognize the revenue ratably.
Meaning it is distributed evenly, a little bit every month, over the entire 30 to 54-month duration of the contract.
Yes. So you have a severe mechanical mismatch. You have the massive upfront shock of depreciation, deployment costs, and facility expenses hitting the income statement immediately, while the revenue trickles in slowly over the next 5 years.
Let's apply a real-world analogy to this because it clarifies the math perfectly. Imagine you own a single, highly profitable restaurant. You've dialed in the unit economics, the cost of food, the labor, the rent, it all balances out, and you are generating a fantastic 25% operating margin.
The fundamental business model is proven, a mature cohort.
Right, a mature cohort. But then you decide to aggressively expand. You decide to open 50 new restaurants in a single month.
Okay.
Suddenly, you are signing 50 new leases. You are buying 50 massive industrial ovens. You are paying construction crews to build out the dining rooms, and you are paying staff to train for weeks. All of these expenses are flooding your income statement before a single customer walks through the door and buys a $15 hamburger.
And if we looked at your company-wide financial x-ray during that build-out month, your operating margin would look catastrophic. It might be 1% or deeply negative.
But the fundamental table-level economics of selling hamburgers hasn't changed. You aren't losing money because you forgot how to run a restaurant. You are losing money on paper because you are front-loading the costs of massive future capacity.
Exactly.
We just have to wait for those 50 new locations to open their doors and start serving meals over the next 5 years.
This is precisely the dynamic occurring at CoreWeave, but on a multi-billion-dollar scale. They aren't just adding a few servers to an existing rack. As CEO Mike Intrater pointed out, they added 400 megawatts of contracted power in Q1 2026 alone.
CFO Nitin Agrawal actually explained this denominator effect perfectly on the earnings call.
What was his example?
He said, imagine you were running 50 megawatts of mature revenue-generating capacity. That's your original profitable restaurant. If you suddenly start building out 300 megawatts of brand new capacity in a single quarter, the upfront deployment costs and immediate depreciation of those 300 megawatts will mathematically crush the ratable revenue trickling in from your original 50 megawatts.
Because the denominator, the established installed base, is just too small to absorb the massive capital expenditure shock of the new growth.
Exactly. But as the company scales, this math naturally writes itself.
Yeah, as Agrawal noted, once you reach a steady state of running 2,000 megawatts of mature capacity and you add a 50 megawatt cluster, well, the upfront costs are easily absorbed by the massive compounding revenue base. The margin impact becomes negligible.
So we can look at this 1% operating margin and definitively conclude that the compression is timing-based, not economic.
Yes. And we have explicit data from the sources to validate that conclusion. Management confirms that their mature revenue contracts, the GPU clusters that have passed that 3-month install window and are actively serving clients, generate contribution margins in the mid-20s.
We also need to look at the adjusted EBITDA metric for Q1 2026. The adjusted EBITDA was $1.2 billion, which represents a 56% margin.
And that is the ultimate proof right there. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It strips out the non-cash accounting charges.
Right.
Operating income, on the other hand, includes depreciation.
So the massive gap between a 56% EBITDA margin and a 1% operating margin proves that the hit to profitability is almost entirely driven by the depreciation of massive new capital deployments.
Yes. It is not being driven by day-to-day operational bloat or unprofitable unit pricing.
The core profit engine is fully intact. As the hypergrowth phase normalizes relative to the installed base over the coming years, management actually has high conviction in targeting a long-term operating margin of 25% to 30%.
And they can confidently project this because of the visibility provided by the take-or-pay contracts. They literally know, down to the dollar, what their revenue will be 3 years from now on the clusters they are installing today.
So the intellectual honesty check is complete. The negative net margins and 1% operating margin are mathematical artifacts of aggressive hyperscaling. When we isolate the unit economics of the mature cohorts, they are highly profitable and structurally sound.
Pillar 3 is secure.
This validates our third pillar. We have a durable tailwind, an unassailable physical moat, and highly profitable long-term unit economics. But none of that matters if the people steering the ship drive it into an iceberg.
Which brings us to the fourth and final pillar: management quality, capital allocation track record, and insider alignment.
For a perpetual hold, you are essentially partnering with management for a decade. You need to know exactly who holds the power and whether their financial incentives align with yours as a minority public shareholder.
Let's pull the data from the proxy statement for the 2026 annual meeting. It gives us a crystal clear look at the leadership team and the power dynamics within the boardroom.
Who's running the show?
The executive leadership consists of CEO Michael Intrater, Chief Strategy Officer Brian Venturo, and Chief Development Officer Brandon McBee.
And the critical distinction here is that these three are not hired guns.
No, they aren't.
They are not professional, rotating Fortune 500 CEOs brought in by a private equity firm to dress the company up /R&D, boost the stock price for a few quarters, and exit with a golden parachute. They are the original founders.
And their ownership structure reflects that. When you look at the voting table in the proxy, it is staggering. Through their ownership of Class B common stock, which carries super voting rights, these three founders hold over 70% of the company's total voting power.
70%?
Yeah. Michael Intrater alone holds 38.7% of the voting power. Brian and Venturo holds 20.3%. Brandon McBee holds 13.59%.
They possess absolute voting control. They are completely insulated from any external hostile takeover or activist shareholder campaigns.
Completely.
Now, I have to push back here, because this ownership structure is the single biggest risk factor we've discussed.
Okay, why do you say that?
Because we have seen this exact movie play out across Silicon Valley over the last decade, and it often ends badly. Having founders with absolute untouchable voting control is essentially a corporate monarchy.
It removes the ultimate accountability mechanism, right? The ability for shareholders to vote out underperforming management.
Exactly. It is a fantastic structure if you have a philosopher king at the helm.
Yeah.
It allows them to completely ignore Wall Street's toxic obsession with 90-day earnings cycles. They don't have to mortgage the future of the company just to beat next quarter's consensus estimates by a single penny.
Right, they can build for the decade.
They could deploy billions of dollars into infrastructure today, knowing it won't pay off for 3 years. But what happens if they get complacent? What happens if they lose their technological edge or start making massive, value-destroying acquisitions driven by ego rather than unit economics?
You're stuck.
In this structure, no activist investor can buy up shares, secure board seats, and force a pivot. The minority shareholders are completely trapped.
That is a highly defensible skepticism. The dual-class share structure demands that the founders earn a structural level of trust. We really have to evaluate whether their actual execution track record over the last few years justifies that trust.
Right. Are they making sound capital allocation decisions, or are they acting like unchecked monarchs?
Well, let's review the tape. We've discussed the massive capital raises. Raising $25 billion while actively lowering the cost of capital by 300 basis points requires immense financial discipline and operational credibility with institutional lenders.
Very true.
We discussed the Core Scientific acquisition. They didn't overpay for a speculative software startup. They executed a highly synergistic, leverage-neutral vertical integration that structurally eliminated $10 billion in future lease liabilities and drove $500 million in run rate savings.
That is the definition of value-accretive capital allocation.
Exactly. They successfully navigated the incredibly complex transition from a private startup to a publicly traded company. And operationally, they engineered the physical and software architecture necessary to reach $5 billion in annual revenue faster than any infrastructure provider in the history of cloud computing.
So this is not the track record of founders who were asleep at the wheel or distracted by side projects. They have proven to be aggressive, highly capable capital allocators who understand how to continuously widen their physical and technological moat.
We also need to evaluate how they are compensated, because compensation drives behavior. If they are paid massive cash bonuses for hitting quarterly top-line revenue targets, they will inevitably sacrifice long-term margins to chase those targets.
Let's look at it. The compensation discussion and analysis section of the proxy reveals that their incentives are structurally tied to long-term value creation. Their compensation is overwhelmingly weighted toward long-term equity.
Specifically restricted stock units, or RSUs.
Right, rather than short-term cash bonuses. Looking at the 2025 Target RSU awards, the scale of equity alignment is massive. InTrader had a Target RSU award of $28.5 million. Venturo is at $16 million, McBee at $10.8 million.
So their personal wealth is inextricably tied to the compounding of the company's enterprise value over a multi-year horizon. They only realize that wealth if the company continues to generate sustainable returns above its cost of capital.
There's one more aspect of management quality that I value highly, and that is communication candor. How do they talk to their shareholders when the news is confusing or superficially bad?
Oh, this is crucial. Let's go back to that Q1 2026 margin collapse.
Because we've seen so many management teams try to hide deteriorating margins by inventing obscure, heavily adjusted non-GAAP metrics, just burying the real numbers deep in the footnotes of an SEC filing.
Right. But CFO Nitin Agarwal took the exact opposite approach. On the earnings call, he proactively confronted the 1% margin.
He owned it.
He walked the analysts step by step through the accounting mechanics of the scaling exercise. He explained the denominator effect of adding 300 megawatts to a 50-megawatt base. He explicitly set realistic, mathematically grounded expectations for when and how the margins would reinflate as the cohorts matured.
That level of transparency, treating the public markets like intelligent partners who can actually comprehend complex capital cycles, is a hallmark of an intellectually honest management team.
Absolutely.
Furthermore, while the founders hold absolute voting control, they have voluntarily subjected themselves to rigorous independent governance. The board includes heavyweights like Margaret Whitman and Glenn Hutchins.
Yeah, that's real oversight.
They have adopted Fortune 50-level corporate governance practices. The audit, compensation, and nominating committees are composed entirely of independent directors. They have established a lead independent director role to balance the CEO's power. They are not running this public company like a private fiefdom.
So, synthesizing the management pillar. We have deeply aligned, proven owner-operators. They possess the structural voting control necessary to execute a decade-long vision without destructive short-term interference. They have an elite track record of highly accretive M&A and capital allocation.
And they operate with a high degree of communication candor, supported by independent board oversight. The management pillar stands firm.
Which brings us to the culmination of our entire diagnostic exercise.
It does. Let's pull all these analytical threads together. We set out on a specific mission to determine if CoreWeave merits a long position for perpetual ownership in a public market portfolio.
Right.
We ruthlessly stripped away the hype of the AI gold rush. We completely ignored the current stock price and valuation multiples. We focused exclusively on the mechanics of the business across 4 foundational pillars.
So what's the verdict?
I'm going to ask you for the final intellectually honest verdict, based only on the durability of the secular tailwinds, the depth of the competitive moat, the reality of the unit economics, and the quality of the management team. Does CoreWeave pass the test for a perpetual hold?
Yes, unreservedly.
Okay.
When you examine the mechanics without bias, the thesis is incredibly strong. The secular tailwind is not a passing technological fad. It is a generational shift in global compute architecture, mathematically evidenced by a near $100 billion contracted revenue backlog spanning both training and complex agentic inference workloads.
The demand is virtually guaranteed.
And their ability to capture and defend that demand is protected by an incredibly deep, multi-layered moat. It is not just about owning NVIDIA silicon. Their moat is built on purpose-built orchestration software like CKS,
Right.
a frictionless zero-egress distribution model that neutralizes legacy cloud lock-in, and a physically unreplicable 3.5 gigawatt power portfolio situated in a globally constrained electrical grid.
And the financial engine powering that moat.
It is a masterclass in risk mitigation. They have leveraged investment-grade take-or-pay contracts to pioneer a self-amortizing, asset-backed debt model that continually lowers their weighted average cost of capital while shielding equity holders from dilution.
And the margins.
The seemingly fatal 1% operating margin is purely a mechanical artifact of hyperscaling and front-loaded JAP depreciation. It masks a highly profitable, mature cohort contribution margin in the mid-20s.
And the management team is structurally aligned to drive long-term enterprise value rather than short-term stock pops.
Precisely. They are proven owner-operators with the voting control necessary to execute a multi-year vision, backed by a flawless track record of value-accretive M&A. When you synthesize these four pillars, the probability that CoreWeave's current massive growth initiatives will sustainably generate shareholder returns above their cost of capital over the next decade is exceptionally high.
It is a remarkable business engine to dissect. But I want to leave you, the listener, with a final provocative thought to ponder as we wrap up this analysis.
What is it?
Over the next 10 years, the actual AI software models, the incredibly complex algorithms that OpenAI, Anthropic, and Google are racing to build today will inevitably become commoditized.
That's true.
The open source community will catch up, the mathematical breakthroughs will become ubiquitous. When the software is everywhere and everyone has access to a genius-level AI, the real monopoly power won't sit with the algorithms themselves.
The ultimate leverage shifts to the physical layer.
Exactly. The ultimate leverage will sit with whoever controls the raw materials required to make the math work. The specialized cooling systems, the ultra-low latency network switches, the massive data center real estate, and most importantly, the millions of megawatts of electricity. The question isn't whether artificial intelligence changes the global economy over the next decade.
No, it's not.
The question is whether you own a piece of the physical power grid that makes that new economy run.
An invisible grid made highly visible today if you know how to read the financial X-ray.
Thank you all for joining us on this deep dive. Keep questioning the consensus narratives, keep looking past the near-term noise of the quarter-to-quarter earnings cycle, and keep exploring the deeper mechanical layers behind the businesses that are quietly shaping our future.